Did you know that nearly 40% of all mortgage applications are denied due to inaccurate income calculations? Not because people didn't make enough money, but because the income wasn't documented properly in the original application. Today, I'm going to walk you through exactly how lenders are calculating the income for 5 different main types of income. And once you understand this, you'll have a much clearer picture of what lenders are actually looking for and make sure that your loan doesn't get denied. So hi everyone, my name is Heather Gennette and I am your mortgage ninja. My goal is to make you a smarter home buyer. So let's get into it. One of the biggest surprises that home buyers discover is that the income on their paycheck isn't always the same income lenders use to approve you for a mortgage. Underwriters are required to evaluate income in a very specific way to make sure that the income is stable, predictable, and likely to continue for at least 3 years. And there are actually 5 major types of income lenders look at when they're qualifying a borrower. So let's break it down. The first is salary income. And this is just super straightforward. You get paid, say, $75,000 a year, and then we divide that by 12 to give you your monthly income. And that's it. It's really, really straightforward, really, really simple. What they're going to ask for is your 2 most recent W-2s and 30 days of pay stubs. And as long as your income and employment are consistent, salary income is generally very straightforward to qualify with. If you just started your job, they may ask for your hire letter that shows what your salary is. If you're hourly, now that can be a little different because the amount you earn can vary depending on the number of hours you work. If you're paid 40 hours a week guaranteed and that doesn't vary, then that's going to be very easy. But what a lender's often looking at is your hourly rate, your average hours worked, your year-to-date earnings on your pay stub. And so if your hours do fluctuate, lenders may calculate an average monthly income using your pay history and W-2 income to determine that you're stable, that your income really is stable. They may also ask for a verification of income letter from your employer stating what your guaranteed hourly hours are, or weekly hours are. The next one that we're going to talk about is overtime, bonus, and commission. Now, this income is considered variable. It's based on a 2-year history. So if you just got into a sales position and you're earning great commission, you're gonna actually need to earn that for 2 years before we can count it. I do have some non-QM lenders that will do 1 year, but there's something very important to realize. When lenders calculate this type of income, they often request the final pay stub from each of the previous 2 years. And the reason is that the last pay stub of the year shows the full year-to-date totals for each income category, including overtime, bonus, or commission. And this allows the underwriter to see the total amount earned in each of those years. From there, they can calculate an average between the 2 years to determine the qualifying income, but they don't stop there. Underwriters also look at your current year-to-date pay stub to see what you have earned so far this year and make sure that your income is trending consistently in the same way that it did the previous 2 years and that you don't have declining income. As long as the income is stable or increasing, that's a sign that it's usually a positive sign. If the income has dropped significantly, the underwriter may adjust the average or use the lower number. There is also self-employed income. Self-employed income is calculated very differently from the traditional employment income. If you own your own business or work for yourself, lenders don't use your gross business revenue. Instead, they use the income reported on your tax returns after business expenses. So underwriters will typically review 2 years of personal tax returns, 2 years of business tax returns, profit and loss and balance sheets. They may also have some add backs for certain deductions like depreciation on Section 179. And this is why many self-employed borrowers are surprised when their income is drastically different than their actual business revenue. A lot of bank statement programs are great for self-employed borrowers because it gives them the total of their deposits versus what's reported on tax returns. And so there's also other income sources that may qualify depending on the situation, and these can include rental income from investment properties, retirement income, Social Security income, alimony or child support, and investment or dividend income or trust income. Each of these incomes have their own documentation requirements, but many borrowers are surprised to learn that these sources can sometimes strengthen their loan approval. So the most important thing to understand is that mortgage underwriters aren't just looking at how much money you make currently. They're evaluating whether your income is stable, consistent, and likely to continue. That's why the income used for mortgage approvals can sometimes be different from what appears on your paycheck or your bank account. But once you understand how lenders calculate income, you can prepare properly and avoid any surprises during the approval process and loan process. So if you're thinking about buying a home and you want to understand what your real qualifying income looks like, I'm always happy to walk you through these numbers. You can use the application link below to get started, or you can reach out directly. And if you enjoy learning how the mortgage process actually works, be sure to subscribe or for more homebuyer education and like and share. Thanks again.